Welcome back, ladies and gentlemen, to another edition of Capital Concepts. I'm Jeff Schuler, Director of Research for Spiker Consulting. Today I want to talk about oil. I want to talk about how you can invest in oil and why to invest in oil. Now, one note I want to make is there's a lot of talk going on about real estate and why real estate should be an investment now. And I really have one thing to say. Please, watch the piece we just did on what's going on in the foreclosure market. And remember, if anybody thinks that real estate prices are going to bounce back in the United States anytime soon, remember this. In Japan, real estate prices are still 50%. 50% of where they were 15 years ago at their peak. Just some food for thought. Now, oil. I've talked a lot about gold, which is at an all-time high now. Palladium, which is making a great run. Love palladium. Silver, which is getting close to its previous high, but still, phenomenal opportunity. Platinum, I'm not doing platinum. Because honestly, platinum and palladium, it's almost the same, and one's $300 an ounce and $320, the other is $1,300, it's a no-brainer. But oil. Oil is a great place to get into right now, today, if you're looking for an investment opportunity that's not begun its run yet. There's a number of reasons why. I'll go into a couple of them. The biggest one is you cannot run an economy without it. Now, right now, over half the world's population are living in countries that their economies are growing. And they're moving not only into a manufacturing mode, but to a factory and productivity mode. China, India. Also understand that Japan has to import all their oil. They've got no natural resources. Russia's beginning to pump it out, but China's buying it all. It's an amazing thing going on right now. And the Saudis, according to my sources, are looking for $90 to $95 a barrel oil anyhow. And they'll get it. Oh, believe me, they'll get it. But the bottom line is this. If I'm right, and I've got a pretty good track record so far, and oil does go, just from right now we're sitting at about 68.82 for London Brent, 71.69 for West Texas Intermediate as of London close today. If it just goes from 70, let's round it off to 70, to 90 with our moderate program of getting involved in it, you're looking at about a 34% net return on your money. That's just going to 90, going to 95, 52%, going to 125, which is not the high. The high was 147.50. It wasn't all too long ago. It's a 159% return. That is taking 100,000 and making it 259,000, just like taking 10,000 and making it 25,900. With our aggressive program, you're looking at 90 being over a 50% return. You're looking at 95 being, my goodness, a 73% return, and you're looking at 125, triple. That's 100,000 becoming 296. That's 10,000 becoming 29,600. Great opportunity, limited downside, phenomenal upside. What do we do? How do we do it? Well, we buy directly in oil. Now, right now, from an investor standpoint, how do you invest in oil? Well, you've got options and futures, which the reason I don't like it is that the market is telling me that I must sell by a certain date. I don't like that. It's too constricting, and I pay a time premium. I pay dollars on top of my investment for that time. And every day that we get closer to that date, that due date, that sell, that end date, that time premium goes down. So my intrinsic value drops every single day. I don't like that. And markets do have a tendency to, well, let's face it, get manipulated from time to time. And I don't want my investment getting manipulated out of it. I don't want to have to sell by a certain date. I don't need that added risk. It's not necessary. I'm not going to make enough more money doing it. I mean, listen, if 34 to 300% return is not good enough for you, well, then you're just a little too greedy, I think. But if we can do it and limit our downside and not have those time premiums that we're worrying about and those time constrictions that we're worrying about, then I'm starting to like it. You can invest in oil stocks. You've got Exxon, Mobil, et cetera, which are great. And so we can pay a dividend. Not a bad way to invest your money. Thing is, if those companies run into problems, then you're going to have problems with your earnings and the stocks are going to go down. If analysts decide that it's not the time or whatnot, those stocks are going to go down. Oil companies don't necessarily make you money when oil prices go up, and they're not going to go up as much. In any investment, when you're dealing with a commodity, like gold, silver, platinum, palladium, or oil, the metal or the oil, the commodity, will always outperform the stock. Always has, always will. And honestly, with less risk. You can go to ETFs. I would recommend against that highly right now. They're all under investigation by the regulatory agencies. They're not matching it one-to-one. As a matter of fact, Deutsche Bank, about 3 weeks ago, pulled its oil ETF off the market for regulatory concerns. So let's take the ETFs and put them to the side right now. There's just no reason to do it. They were good for day trading. If you want to be a day trader, it's a good thing, but why get caught with it? Why take the risk? You can go into mutual funds that go into a number of different vehicles, including the different stocks that are involved. And you spread your risk, but you're really diluting the reward. It's a conservative way to do it. You're not paying a ton of money for it. Not a bad way to go. It really isn't. It's not a bad way to go. You're not going to make a lot of money doing it that way, but you're not taking a lot of risk. So if you don't want to make a lot of money and you want to have an exposure to those kind of stocks, that's what a mutual fund is for. It's not bad, and it's not something that I do, so there is that objectivity thing to worry about in there. But again, I can't say much wrong about that. A well-managed mutual fund run by a savvy investment professional team, not a bad way to go. But for me, I like the opportunity to make people significant returns while taking about the same amount of risk, maybe a little bit more. And if my clients stay in the game, if they just stay in the game, oil's never going to zero. Let's put it that way. Stock can, oil's never going to zero. Again, oils don't have accountants. Oil doesn't have earnings reports. Earning doesn't have CFOs that can abscond with money or cook the books. They don't have regulatory dinners. They don't have employees who can go on strike. They don't have to worry about layoffs or anything like that. They don't have to worry about competition. It just has to be it. Just has to be what it is. So right now, I like the opportunity. We're at a relatively low period in prices. It's been consolidating, a nice base at these levels, being what is about $64, yeah, $64.75 recently, up to about $71, $72. Been consolidating this base, getting ready for what I see as a significant run. And again, getting just from 70 to 90, we're looking anywhere from 35 to 50% net return, depending upon the program you go into, upwards of 100, 200, 300% of your money without getting back to its highs. I'll tell you what, ladies and gentlemen, in my book, that's a risk-reward ratio I want to get involved in. Learn more, 888-779-5374, locally in the area. Actually, better for you, go to our website, www.spykermetals.com. Ladies and gentlemen, I hope you've enjoyed this segment of Capital Concepts. It's been absolutely fantastic day. Until the next time we speak, may God bless you all.